AdaptHealth lost just over 38% in a single trading session. Monday, the stock closed at 1083. Tuesday, 671. 19 million shares traded that day, about 18 times normal volume. And here's the part almost nobody's talking about. Most of the loss behind that crash wasn't even cash leaving the building. What's up, guys? Coach B here. This is the breakdown. Quick reminder up front, this is education, not financial advice. I'm not telling you to buy AdaptHealth or sell it. I'm using it as a real live example to teach you two things: how to read a GAAP loss that's mostly a paper charge, and how to read an options chain after a crash without jumping to a conclusion it can't support. AdaptHealth, ticker AHCO, is a home medical equipment company. Wheelchairs, oxygen, sleep apnea machines, that kind of thing delivered to your house. NASDAQ small cap, about 136 million shares outstanding. Boring business until Tuesday morning. AdaptHealth reported second quarter earnings before the bell on August 4th. Revenue came in at $740.3 million. Wall Street wanted $847.2 million. That's a real miss. But look at the other number next to it. That 740.3 is actually up about 12.7% from 657.1 million a year ago. This is a growing business that missed a number, not a shrinking business. Then you get to the bottom line and it looks a lot worse. GAAP earnings per share came in at negative 99 cents. The street wanted positive 15 cents. That's the kind of headline that makes a stock crater. But before you panic on a number like that, you have to ask what's actually inside it. AdaptHealth took a $144.2 million goodwill impairment this quarter. That's not cash walking out the door. It's an accounting write-down on old acquisitions. Basically, the company saying we paid more for some of these companies years ago than they're worth on paper today. Do the rough math with me. 99 cents a share times roughly 136 million shares is about $135 million of total GAAP loss. The non-cash write-down alone was $144 million. That's bigger than the entire reported loss. Back that one item out, and this quarter was close to break even, maybe even slightly profitable on paper on a business that's still growing revenue. That's the whole lesson right there. A scary EPS number can be almost entirely a paper charge. Always go find out what's actually inside a loss before you react to it. Now, here's what actually justified some of that selling. AdaptHealth didn't just miss and take a write-down. They slashed full-year guidance. Revenue guidance dropped from a midpoint of $3.49 billion to $2.87 billion, about a 17.6% cut. Adjusted EBITDA guidance dropped from a range of $680 to $730 million down to $490 to $520 million. Management pointed to two things: a West Coast capitated contract ramp that's pressuring margins by about $55 million and an unexpected manufacturer price increase costing around $30 million. Guidance cuts like that are why the options market went from calm to violent overnight. So let's go look at the chain, because this is the part that should make you pause, not predict. Spot price 671. Next expiration, August 21st, 16 days out. At the money strike, 750. Here's the interesting part. After a 38% crater, this chain is almost entirely calls. At that 750 strike alone, 508 call contracts traded against just 30 puts. Across the whole chain, total call volume was 551 contracts to 82 puts. That's roughly 7 times more call volume than put volume the day after the stock got cut by more than a third. Now, what does that mean? Honestly, I don't know, and neither does anyone telling you they do. There are two real explanations, and they point in completely different directions. One, this could be pure speculation, cheap sub $10 lottery tickets. Those 750 calls were going for somewhere between 10 and 20 cents. So for under $20, you can control 100 shares betting on a bounce. Two, it could be short covering or hedging flow. Funds that were short the stock or holding puts, buying calls to cap their risk, which has nothing to do with anyone betting on a rally. Same chain, two opposite stories. I'm not going to pretend I know which one it is, and you shouldn't let anyone tell you they do either. That's the honest answer. If I'm thinking about a name like this at all, time frame matters more than usual. A stock that just moved this much with 16 days of options on the board is going to be violent short term. That's a day trader's playground. not a set it and forget it position. If you're thinking longer term, the real test isn't this print, it's the next one, November 3rd, when we find out if that guidance cut was the bottom or just the first cut. So here's what I want you to take from this one. First, a scary GAAP loss can be mostly a non-cash write-down. Always check what's actually inside the number before you react. Second, an options chain flipping to calls after a crash is a fact you can observe, not a signal you can trust blindly. There's always more than one story that fits the same data. Quick reminder again, this is education, not financial advice. Do your own research before you touch anything like this. That's the breakdown on AdaptHealth. Drop your questions in the comments, and if this helped you read a headline loss differently, hit subscribe. I'll break down the next name on the board. Good luck in the markets, no matter what stock you're into.